So, to have the thought of the market going down and to want to sell, that's pretty normal. But actually doing that, the facts bear out, really work out poorly. There's a study done, which you guys can Google, done by a company called Dalbar, D-A-L-B-A-R. And that's done every few years. And what they do is they look at investors' performance versus the stock market. And to do that, they go through hundreds and sometimes thousands of statements. And what they found is the average market performance in one period might be, during the study, an average of say 8% or 10. And the average investor performance is down closer around 3 or 4. And the reason why is that behavior of selling either part of the portfolio or, we forbid, all the portfolio causes really poor performance. Because when you sell low or part of the way down, it's very, very unlikely that you put the money back in at a lower price. So usually the money goes back in well after the market's gone back where you sold and then higher. But the real solution is that declines are really just a natural part of investing, and the facts really bear out a different story about recovery. So let's talk a little bit about that. One of the most sage investors, Warren Buffett, is one of his famous quotes is, stock market is the most efficient mechanism anywhere in the world for transferring money from impatient people to patient people. So I think the key thing there is that, people do lose money, then they sell, and then they buy back in higher. But then also patience is really what we need to have. So let's look at that. Let's look at the history of stock market declines. I would say if you look at the type of decline, let's break it out into 3 kinds of declines. 0 to 5%, or 5% rather, 10 to 20%, and then 20% or more. So, a 5% decline is actually really common, and we typically see that on average 3 times a year. Market moving back down 5% or so from where it was, and that happens like 3 times a year. And the average length of time to return is only 46 days, so less than 2 months. Now, the second type of decline is what we call a correction, and that's minus 10% to 20%. And that happens on average about every 2 or so years. And that's where we are right now, interestingly. We are in between minus 10% and minus 20. Interestingly, the average length of time for that is about 216 days. Now, the last time we had a correction of more than 10% was October 2011. So it's been, 4, almost 5 years that we've gone on here without this type of occurrence. So, and then lastly, we call it bear market, which is usually accompanied by a recession, and that's a decline of 20% or more. And that occurs about every 5 years, about every 4 years. And the length of recovery there takes almost a year, 338 days. So I just want to just take a look at a chart here we put up. And that's going to show you the stock market over the last year, all the way through last week. So this is the Dow Jones. So this is the last 365 days, and if you can't see it on your computer, I'll just explain it to you. The high on the Dow Jones was in May of last year, May 2015, and that was 18,312 points. So 18,300 was the high in the Dow. And the Dow today is around 16,400. Now, the market hit a low in late August of 15,000, almost 700, I'm going to say. So we went from 18,300 in May to 15,700 in August. And then the market rallied. If you can remember that, it rallied back decently at the end of the year, and we ended up with a very, very almost break-even slight gain. So high in the Dow was 18,000, low in the Dow was 15,700, and then we rallied back up to high 17,000 at the end of the year. Then we go back down again in January. In January, we hit almost a new low, and then again in February, the very first week of February, we hit almost exactly the same low that we did back in August. So, and now of course we've rallied a little bit and we're at 16,400. So the point is, one thing is if the market doesn't go to a new low and we stay in this correction territory, now we're back to just the facts. And the facts are what? The average period of time we need to wait is about 220 days. Right now we're 250 days into this correction, this 10 to 20% correction. So you look back last May, now here we are in February, we're wondering if we hit the low. And if we did, and we haven't hit a new low yet, that would be actually good news. What's the longest amount of time that we had to wait for a recovery? Over 400 days. So we're still in, if you put your hands out in front of you, you're still in a bookend. We still have, we're past the middle of what the average would be, but we have, still quite a number of days to go where we go over 400 days to recover our money. So, the facts show that if we don't go lower here, we should see ourselves in the market recovering back to its normal. And whether that'll take the rest of this year, if we go the rest of this year, that would push us around 400 days. And, pick your poison, obviously, this year. There's, the real issue is the global markets are slow. Europe is still struggling. Obviously, the news that China dropped with their economy recently, is bearish. But, economies take time to rebuild themselves. And we just need to be patient. And the stock market, if you know this, it really sells in advance of any bad news. So right now, really last fall and today, the market's saying we think there could be slowness, which means that maybe we will use up this whole bookcase full of days. But again, I think it's somewhat positive that we haven't gone lower. So let's talk about, since we don't know, let's talk about what we can do. So there's three keys to prevailing during stock market declines. One is, let's have mental awareness of the facts. Stock market declines don't last forever, and typically corrections don't last more than a year or a little more than a year and a third. Secondly, if you're a client and you're listening in, your retirement income portfolio is designed to weather the storm. Meaning that, yes, there's money in stocks, which are down right now, but other areas of your portfolio are not. And that's like a retirement income portfolio that kind of looks like a pension behind the scenes. It's still available, working, the motor's still running, and it can still pay you income. And then the third thing is something that we can control as well. Regular communication with us to ensure that you have adequate liquidity. Make sure that we understand what's going on with your situation. If there are new expenses coming up or if there aren't, we just talk that through. And, for example, today I talked to a client and they're having some health issues. Fortunately, they're going to be fine, but it may involve a few $1,000s more of some therapy and some just ongoing post-hospital stuff. Is it a big deal? No, but they just wanted me to know that they're going to take a little bit more money out this quarter, and it was really no problem. So I think that's the point. just make sure we just stay ahead of what's going on in your life. So we look forward to hearing from you when you have these either urges, questions, or important benchmarks that we're looking at. So let's look at some of the facts here. One of the things you might ask is, how are some of the funds that we recommend and that are commonly held by our clients in your portfolio performing? So right now, stock market's down through today. Year to date, the stock market's down 5.5%. So it's rallied actually. The market was down at one point about -12, and now it's down -5.5. So it's made up some of its low, which, as we were saying before, might be good news. But let's take a look at some of the funds we own. I'm going to go through just a quick list. American Funds Balanced is down -3%. Dodge & Cox Balanced is down -5. T. Rowe Price Capital Appreciation is -5. Vanguard Short-Term Bond is not in stocks. That's up 0.5%. Vanguard Wellesley, which is a balanced fund but is conservative, has a gain of almost 0. And the TI CREF real estate account has a gain of a little less than 0.5%. Compare that as you're thinking, as I'm listening to me, the stock market's down 5.5. So really, all of the funds in their categories are doing their job. And if we have bonds, which you do, if we have TI CREF, which you do, that part of the portfolio has no loss and has a small gain. So, how do we actually translate that into action? So you've heard me talk about the buckets. You've heard Frank talk about the buckets, Bill, and how do we use the buckets? Well, it's really just a way of saying, hey, there's 3 buckets that we could kind of spread our money out into visually. So you got a short-term or a cash bucket. We've got an income bucket in the middle, and then we've got a growth bucket down on the end. So, if for this chart, if you can see it, say I have $1 million, I might have 100,000 or 10% in the cash short-term bucket. That may not be in cash, but it'd be in short-term account, whether that be guaranteed or whether that be bonds. Then I would have, after that 100,000, I might have 450,000 in the income bucket, and that would be in bonds. That would be in TIA CREF. And then finally, I might have 450,000 or 45% in balanced funds and some stock funds. So I got these 3 buckets, and each one of the buckets is available in order of appearance. So the first bucket I'm going to use is the cash bucket, and that is, if you needed typically say $30,000, $40,000 of withdrawals, that cash bucket's got anywhere from 1 to 3 years in it. Then I go to the income bucket, which is the middle bucket. If that's got 45% of the money, or 450,000, that's enough money to last maybe anywhere from 3 to 15 years. And then finally, we reach the growth bucket on the right, and we've gone in picture, in concept, and also if we had to in real life, we could go like 15 years without having to touch the growth bucket. So what's the aha there is that we got 15 years for the stock market to go back up higher. So this is one way we try to create peace of mind, but it's also another way we also try to manage cash flow and also withdrawals. And what I like to do is just turn it over if anybody has any questions. And I'll just say this. I have one question about the balanced funds and about, okay, so I'm going to go back to the fund chart here. And okay, so what the question is the market's down 5.5%. The Dodge & Cox fund is down 5.5%. But the American fund and the Vanguard fund aren't down nearly as much. Why is the American fund and the Vanguard fund doing better and the Dodge & Cox fund not doing as well? The answer is that they have a little bit different style. So the American and the fund is more of just a real balance between stocks and bonds. So naturally, you're going to lose less than the market with just a pure balance. But the Dodge and Cox fund has balance, but they choose, and we like them to do this, pursue stocks which are value oriented and pay a dividend. And last year and a little bit lately, the market has been favoring growth stocks over stocks that pay a dividend. But that can easily change back around as it normally does. And you could see that Dodge and Cox fund having a nice gain compared to the others. So we have different styles in the recommended funds that we use. Any other questions here? I don't see any. Well, we'll just wait a second. And I'll just say this on behalf of everybody here, Frank, Kitty, Bob, Bill, Frank, Roseanne, Amanda, Eileen, Heidi. We'll say thank you and allowing us to help you. And you know how to contact us. And please reach out if you have any questions on today or just anything that you want to talk about your own situation. Appreciate it very much. Thanks very much. Okay, bye-bye.